Thanks for tuning to Talking Point. I'm your host, Neeraj Shah. Our guest today is Andrew Holland of Avendus, and they, of course, runs the largest Cat 3 IF. Lovely to get his opinion on how does he feel about the current market exuberance. Andrew, would it be right to call it exuberance, or is this the natural upswing after the multi-month lows clocked in around March?
Yeah, no, I wouldn't quite say it's exuberance in that respect, because we do have, the market's more broad than it is in terms of, the number of stocks rising compared to, say, the US, where it's, 7 to 8 stocks.
Yeah.
So I wouldn't say it's overbought. I would say, though, that obviously, the kind of big caps and small caps are seeing, some very strong momentum. So maybe if anything, there might be a little bit of exuberance there, but in the main index, no, I don't see that at all. It's been a gradual kind of pickup. Don't forget, we're up 3-4% for the year, so I don't think there's any exuberance there in terms of the Nifty. But obviously, mid caps and small caps are enjoying a bit more of their day in the sun at the moment.
Yeah, actually, you're right. YTD, it's about 3-odd%, so nothing that great, you could argue. Here's a question, Andrew, though. If indeed the economy growth is not as strong on the global front, and if some repercussions of that are felt in India as well, however insulated India might be relative to some of the others, would it be safe to assume that the margin of safety would be higher in the larger names as opposed to the smaller names, simply because of economies of scale, better financing terms, so on and so forth? And therefore, should one be cautious in this rally? Is it a good idea to book part profits into some of the small caps which have had a really strong run in the recent past?
Yeah, of course, it's always tempting. It depends on, if you bought, mutual funds or individual stocks in terms of, where you want to take profits. But this is what I was saying, Niraj, and it's a kind of a bigger picture view. So bear with me a second.
Sure.
In that, we talked before previously about, when the downturn comes and whether it's recession and so forth. What we do know is that interest rates will have to fall globally. And of course, growth will come from emerging markets. Now, in that period where you're saying, okay, the global economy goes down, then obviously, exports, our growth will start to slow. But our domestic economy is still strong. And in the second half of the year, with all the government capex and private capex coming through, I think that will have a multiplier effect as we go forward into 2024. So whilst it's tempting to say, yes, take some money off the table in small and mid caps, I think we're just starting the kind of run for earnings domestically. So whilst it might be challenging in the very short term, I think going forward, that's where you're going to get the more money for, in terms of returns for overall for India. So yes, if there's some unintended consequences of higher rates, our markets could go down on the back of global markets falling. But previously, if you remember, I used to say, I'm not a buyer into this market. I'm not a buyer into the dips. Today, I would say that if markets were to correct, I would be a buyer into those dips. So it's a more constructive on the markets going ahead.
That's music to the ears for the bulls, Andrew. Do you foresee, therefore, a corrective move, if at all, because of the rally that we've seen? And what quantum of correction, if you will? Would it be like 4-5% on the index, or would you be very, very stock specific even, or theme specific, even when you are buying into the correction?
So a good question. In terms of, it's going to be a global event, right, which will hurt our markets. So I don't think there's anything at the moment I can see, whether it's, oil prices are coming down, commodity prices are coming down. That's all good for inflation. We're still of the view that RBI, if they really want to, can reduce rates in October of this year by 25 basis points. So, the kind of base is there for, the markets to continue to go higher. But here's the thing that worries me more and more is that with higher rates in the US and potentially now even higher rates, I just wonder if the unintended consequences moving away from the regional banks into commercial real estate. And that's a bit more scary because, the Fed can't really kind of go and bail out every commercial real estate company. So that might have more ripple effects. would that impact our market share? I mean, that 4-5%, could well be the kind of fall we would see. I think it'd be half of what we saw of any fall in global markets, to my mind. The second point is that, and don't forget, if the markets fall in the US, it could be those 7 to 10 kind of technology stocks which bring the markets down. And if that's the case, then it's not so bad news in terms of the correction. In terms of what would I be buying, I'd be buying into the themes which we talked about many times, but just to repeat, defense, renewables, which is not just an India story but a global story. Domestic kind of spending more aimed towards airlines, hotels, where I think people will continue to travel within India and spend their money there. And the new one is probably beverages, not just alcoholic, but non-alcoholic as well, where I think the premiumization is really at the very start of what I think to be a very big up move as people move up the kind of value chain in terms of what they drink going forward. So I think that's great for margins for those companies going forward, but just at the start of it. And finally is the CapEx cycle, which I mentioned is government and private, but again, a little slightly different in that not the BHLs and L&Ts of this world, but more the ABB Siemens, because I think the smart factories, smart offices is where they'll really be able to kind of make a lot of money and enjoy higher margins.
Okay, I'm going to peel off a couple of layers of that answer in a bit. First, the slightly bigger picture. Andrew, you would have looked with keen interest, as has everybody, with the Prime Minister Modi's visit to the US. The sound bites, of course, expect the sound bites to be good, but just the sound bites around the event as well. It's not about what Elon Musk said or what some others would say. Just right around this whole period, there is an announcement or a report yesterday about Pixel looking to, or Google looking to transfer some bit of Pixel manufacturing back to India. Micron's $2.5 or $2.7 billion investment into India has gotten the approval as well. There are a lot of non-PM Modi connected but India-US connected sound bites that turn very constructive. What do you make of all of this and India's position in a disjointed geopolitical world?
Yeah, well, obviously the US-China relationships are still not improving, right? So I think that's part of the key. There's a disillusionment about China and the growth prospects there as well. So, if you're looking at, am I going to get growth in China? Possibly, you will, don't get me wrong, but I probably need to diversify that risk. And India's, looking as though it could start to continue to fire in all cylinders. So therefore, I can diversify with my investments in India outside of China. I get domestic demand, and I could get export demand as well going forward. So I think the whole electronics sector is going to be, in 3-4 years' time, we'll be talking about electronic companies only, because I think the domestic potential is huge, but I think the export potential is also huge as well. So there's not many names to play with, but I suspect that we're going to see a lot more companies move into this area, so I think we'll have a lot more diversified number of names to invest in going forward. But it's going to be a huge industry. So again, a bit like the beverages, you just at that kind of starting point, the start of the runway, and there's quite a long runway before you take off.
Okay, the other slightly technical factor that I wanted to get your view on before I come to themes was this insane number of block deals, large deals that are happening in the market. I mean, a bunch of promoter entities are selling some stake in their Indian subsidiaries or some investments that they would have done. And these are large ones. Now, some of these are getting lapped up also very well. My question is this an indication of smart money getting out at peak? Or is it an indication of there being an offering which is equally good for both sides, and the buyer entities would also come in and make money over a period of time? How do you read into it? Because just the number of deals that are happening in the last few days is very, very large.
Yeah, no, it is, and the participation by long only funds as well as other funds has been very significant. I think it's helped that it's been, I suppose, a cleaning up trade, as they call it, in terms that there's no more overhang now on the stock.
Yeah.
So if you take one of them today, I'm not going to try and name the names, but it's trading at a very deep discount to the valuations of other kind of NBFC type companies. So once that overhang's gone, then you could see a re-rating. I'm not saying they'll get the same ratings as other NBFCs, but at least that gap could be closed, and that's what the potential is, and that's what people like.
Yeah, well, we've seen that with that one NBFC today. We saw that up move in an AMC yesterday. So lots happening there. Okay, thanks for that view. Just one more follow-up before I come to themes, Andrew, and this is maybe a thematic question too. But we've seen some large global funds come in and buy into companies which are emerging in India after they've done a 5, 7, 8x run up in the last couple of years. I mean, railway companies are a case in point where we've seen some large investments done. In some auto anchs, we're starting to see that as well. What do you make of it? Is it some large funds buying into conviction around multi-year growth stories, or is it a FOMO effect of sorts?
Well, it's difficult to kind of answer for other people's investment ideas, but I would have thought size might be a part of the reason as well. As companies get bigger, it means there's more liquidity. You can actually buy into the stocks. That might be part of it. It might be part of an index, so they've had to get weightage there. But if you take those two sectors of railways, I think everyone's been surprised at how well the kind of ordering's been there, and the changes that are happening in the railway industry in India. So I think that's a positive for that one. In terms of auto parts, we've always said that whether it's difficult to say who's going to be the winner in EV. That's for sure. But we know that all the component players are going to have to play a part in building this. So I think that's just a catch-up trade, to be honest. But if we're taking the view that domestic consumption is going to continue, people will want to own more and more cars, and the technicals in terms of what's in the car keep changing, then this is going to be good for the auto component players as well. So possibly a bit of a catch-up.
Got it. Now let's talk about what large funds are doing, and why are large funds like yours interested into beverages? Now, you briefly told us about this in this interview ahead. I would love to probe a bit, because the alcoholic beverage scene, for example, has been around, has that mode, but hasn't quite delivered the returns. And I heard you say that you're also looking at non-alcoholic beverages. I know a bottling company, I know maybe one more, but there aren't too many options out there, or are they?
Yeah, I mean, you could look outside of say alcohol into soft drinks and so forth. So that's what's happening, Niraj, and I'm a little bit older to be the catalyst behind this. But when you're out and when you with the young population in India, it's not just saying, okay, I'm going to. They might start off at the cheap brand to start with, but then they're starting to move up very quickly to the premium brands, and that's across. How many people do you see drinking iced tea and all of this? Right, it never used to be like that. So everyone's moving up the curve a lot quicker in terms of what they want to buy, and I think that's a trend that's not going to go away from us. If you just think about the number of kind of restaurants now which are more specialized in terms of their offerings, higher end, and you can't get a table. So this is something that I think with 400 odd million of them, it's not a trend that's going to go away very quickly. So I think that's why I'm more kind of positive on the beverage industry overall, given that you've got a long runway here for this to develop over the years.
The starting valuations are not a hindrance.
No, you see, yes, you can say, listen, the PEs are high, but what are they going to? Where are these companies going to be in 3 to 4 years' time? And I think that's the key, right? You can look at valuations now and say, In 3-4 years' time, maybe they're on a PE of half of what you're saying today. Now, would they trade on half the PE they are today in 3 years' time? The answer is no. They would trade at maybe the same PE. So that's where you'll get your returns.
Got it. I heard you speak about CapEx slightly differently in that you spoke about why buying into maybe the expensive ones might actually be a good idea because of the models that they have. Please tell us if you believe that the CapEx cycle that is unfolding in front of us, while similar in the macro trend to 2003 to 2008, if at all, but would have different characteristics because of the nature of the CapEx. Tell us, how are you thinking about it?
So listen, there's no escaping the fact that we're building lots of roads and bridges, and that's the great news, right? But that's the same as the 2003 to 2008 capex cycle you mentioned. I think that since then, we've understood that execution is partly the key in that as well, and that's not been one of the great, buying reasons to get into some of these stocks. I've always felt that. With the L&Ts and BHLs of this world, that basically it's more of order flow rather than order execution. But if we're correct, Niraj, in terms of, we're going to get more and more different companies coming into India with different requirements, say for factories, the smart factories. It's going to be the APPs and Siemens of this world, and that's a much higher margin business. So if you're saying that India is going to be a manufacturer to the world or a office to the world, then these are the companies which will benefit the most.
Great point. Thanks for that, Andrew. Last two questions. One is, again, I heard you in this interaction talk about how at some point of time in the next 3-4 years, we are going to be talking about electronics only simply because of the nature of the beast. The newspaper report, I think yesterday, spoke about India exporting a massive number of iPhones. I mean, and we just seeing iPhones getting started off. So how to play this? Because there are, again, just a handful of companies or a handful of stocks. And to almost everybody's mind, these stocks have already rallied quite a bit.
Yeah, I see. It goes back to what I said before about the beverage companies. You've got to look 3 to 4 years, 3 to 4 years out. Where would this company be? What kind of earnings would it have accelerated to, and what kind of PE would it be on in 3 to 4 years' time, rather than look at today? You're right, and that's what I mentioned. It's very difficult to find, a whole host of names. But what happens, Niraj, in these circumstances is that more and more companies will move into this area. So that's what I'm looking for. Who's moving into this area, and what credibility do they have? And maybe that's the way we can play it in the future. But at the moment, you're right, it's very limited, which pushes the kind of valuations high. But if those are only players left in 5 years' time, I would have thought that the valuations are probably justified.
Yeah. Viewers, keep in mind what Andrew Holland is saying about how where the companies could be in 2, 3, 4, 5 years' time, and maybe try and think of that when you're looking at the starting valuations. Andrew, my final question, we spoke a little bit about PM Modi's or other India-US thing, but is there something that you are anticipating from this much high-profile visit of Prime Minister Modi to the US?
I mean, obviously, I would... we've been saying for some time now, Niraj, and we spoke about this over the years, is that, under Prime Minister Modi, India's got a seat at the top table. And it, whilst it was kind of there, I think it really is being acknowledged more and more now. So I think India's, can I'm not saying dictate to the world, but I think can have at least a share of what's going on and how things will develop going forward. So I think that's the good news. Yes, you're going to expect all the usual noise around, contracts and this. There's been some rumors of obviously a rating upgrade by one of the rating agencies in terms of India as a whole, which I think should be there anyway, given the stability of where we are compared to other markets and other countries. But I suppose that would be more market-breaking news than saying one or two companies saying they're going to come into India. That's expected. It just adds to the kind of favorable kind of outlook for India going forward.
Okay, Andrew, we'll leave it at that. Thank you so much for taking the time out and giving us your thoughts today on Talking Point. Lovely having you as always.
My pleasure, and thank you for the opportunity, Niraj.
Not at all. The pleasure is entirely ours. Viewers, thanks for tuning into this edition of The Talking Point.
See you. Have a good time.
Thank you.